Imagine a scenario where the US dollar index is holding a tight horizontal range. There is no momentum and no clear trend in the world's reserve currency. Yet, at that exact same moment, the USD-CAD pair suddenly drops 100 pips. For a trader looking only at technical indicators or the dollar index, this move appears out of nowhere. There is no news on the calendar, but the stop losses on the long side are being hit regardless. The driver behind this move is often found in XTIUSD. The X designates it as a commodity index, TI refers to Texas Intermediate, and USD indicates it is priced in US dollars per barrel. This ticker tracks the price of light sweet crude, a specific grade of oil produced in the United States that serves as a primary benchmark for the global energy market. Because oil is a primary input for global manufacturing and transport, the price action on this chart often dictates the flow of capital into and out of major currencies. Since global oil is priced in US dollars under the petrodollar system, the two assets often move in opposite directions. When the US dollar loses value, oil becomes less expensive for international buyers using other currencies. This typically increases demand, which in turn supports higher oil prices. This relationship is particularly visible in Canada, which operates as one of the world's largest net exporters of crude. When the price of XTIUSD rallies, the total value of Canada's exports increases. This surge in revenue increases global demand for the Canadian dollar, as international buyers must ultimately settle these transactions in the local currency. As the Canadian dollar gains strength against a flat or weakening US dollar, it causes the USD-CAD pair to move lower on your screen. By monitoring these capital flows, you can often identify a currency's direction before the trend is fully established on a standard Forex chart.
While these correlations are useful, oil price action is frequently interrupted by scheduled fundamental events that override technical patterns. Every Wednesday, the Energy Information Administration releases its inventory report, which provides a snapshot of how many barrels of oil are currently held in U.S. commercial storage. Market reactions here depend on expectations. If the market anticipates a large draw, meaning a reduction in stored oil, but the actual report shows a smaller than expected decrease, prices can fall as traders react to the surplus relative to their forecasts. Beyond the U.S., the Organization of the Petroleum Exporting Countries, or OPEC+, manages global supply through production quotas. A sudden production cut announced by these members can send prices surging through established technical resistance levels in seconds. Most retail traders access this market through contracts for difference, or CFDs. Thus allow you to trade these price swings without having to manage the physical delivery or expiration of futures contracts. However, CFDs involve a cost of carry. Holding a position overnight includes swap rates and adjustments for the difference between current spot prices and future contract prices, a situation often referred to as contango. Navigating this market requires balancing the impact of supply data against these daily mechanical costs. XTIUSD is a high beta asset, meaning its daily percentage moves are typically much larger than what you see in major currency pairs like URUSD. Because oil is prone to intraday price spikes that can span $1 or more in minutes, a static 20 pip stop loss will often be triggered before the actual trend develops. To manage this, many traders use the average true range, or ATR, to set dynamic stops. This ensures your exit point is based on current market volatility, rather than a fixed number of pips. You can also use oil as a confirmation tool without ever placing a trade on the commodity itself. For example, if you see XTIUSD break a major 6-month resistance level, you can use that as a high-probability signal to short the USD-CAD pair, taking advantage of the correlation with the lower volatility of the Forex market. Understanding how energy prices influence currency valuations allows you to see the logic behind moves that others find inexplicable. To start tracking these correlations yourself, you can open an FXNX Deno account for real-time data and download our commodity correlation cheat sheet today.